EPK Capital presents Deep Dive Nestle India. Hello everyone, welcome to EPK Capital's Deep Dive video. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today, we are going to talk about Nestle India. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. This company, for millions of us, it's the sound of a quick lunch, a late night craving, or even a childhood memory. But it's also the sound of a financial juggernaut at work. Behind Maggi, Nescafe and Kit Kat is a company that has been a part of India's story for over a century, Nestle India. Today, we're not just talking about noodles and coffee. We're conducting a deep, unbiased investigation into the stock of Nestle India. Is this fast-moving consumer goods, FMCG, giant a resilient fortress for an investment portfolio? Or is it a classic case of a great company at a dangerously high price? We'll dissect its century-long history, crunch 10 years of financial data, apply the legendary Benjamin Graham's valuation formula, weigh the bull and bear cases, and confront the controversies that have tested this company to its core. Our goal is not to tell you what to do, but to give you the tools and the knowledge to decide for yourself. The making of a behemoth. Company, brands and promoters. From Swiss Alps to Indian kitchens. A century of history. To understand Nestle India today, we have to go back to 1912. That's when its parent company first entered the country, operating as the Nestle Anglo-Swiss Condensed Milk Company and primarily importing and selling finished products. The real foundation of the modern company was laid after independence. Aligning with the Indian government's focus on local production, Nestle India Limited was formally incorporated on March 28, 1959. This wasn't just a paper entry. In 1961, the company established its first factory in Moga, Punjab. This was a landmark event that not only kicked off local manufacturing, but also transformed the region's milk economy by creating a robust procurement infrastructure for local dairy farmers. This commitment to building local capabilities continued for decades, with major factories being set up in Nanjangud, Karnataka in 1989, Samalka, Haryana in 1993, and 2 facilities in Goa in the mid-90s. In a symbolic move in 1989, the company changed its name from Food Specialities Limited to the now iconic Nestle India Limited, cementing its brand identity. The power portfolio, 4 pillars of dominance. Nestle. India's strength lies in its portfolio of iconic brands, which are organized into 4 core business segments. This diversification across different food categories provides stability and multiple avenues for growth. 1. Prepared. Dishes and cooking aids. This is arguably the most famous segment, completely dominated by the Maggi brand. From instant noodles to sauces and seasonings, Maggi is a cultural phenomenon in India. This segment accounts for approximately 31% of the company's revenue. 2. Milk products and nutrition. This is the company's historical foundation. It includes heritage brands like Milkmaid and Nestle A+ Milk, as well as dominant players in the infant nutrition space like Cerelac and Lactogen. This segment is a major contributor, bringing in about 38% of revenue. 3. Confectionery. A powerful growth engine for the company, this segment is home to some of India's most loved chocolates. Brands like Kit Kat, Monch, and Milky Bar are market leaders and have seen tremendous growth, making India the second largest market for Kit Kat globally. 4. Powdered and liquid beverages. Anchored by the globally recognized Nescafe brand, this segment covers everything from instant coffee to ready-to-drink iced teas under the Nestle brand. It's a cornerstone of the company's out-of-home consumption strategy. The hand on the helm, ownership and leadership. Nestle India is the Indian subsidiary of the Swiss multinational giant Nestle SA. The parent company is the primary promoter, holding a controlling and stable stake of 62.76% in the Indian entity. This stake is held through two entities, Nestle SA itself and Maggi Enterprises Limited. The company's leadership in India is spearheaded by Chairman and Managing Director, Mr. Suresh Narayanan. He has been at the helm since 2015 and is widely respected for his steady leadership, particularly for navigating the company through the severe Maggi crisis, a period we will discuss later. This strong parentage is both a strategic asset and a potential risk. On one hand, it grants Nestle India access to a world-class R&D pipeline, a portfolio of global brands that can be introduced to the Indian market, such as the planned launch of Nespresso, and a global reputation for quality and safety standards. On the other hand, this relationship comes with costs and risks. The Indian subsidiary pays a significant and recurring royalty fee to its parent, currently set at 4.5% of net sales, which is a direct outflow of cash that could otherwise go to minority shareholders. Furthermore, global controversies surrounding the parent company, even if they don't originate in India, can create reputational headwinds and impact the stock price of the Indian listed entity, as seen in recent allegations regarding baby food formulations. An investor must therefore weigh the benefits of global expertise against the costs of royalties and shared reputational risk. A decade under the microscope. Financial analysis. FY15, FY25. Now, let's move from the story to the numbers. A look at the last 10 years of financial performance reveals a story of crisis, resilience, and powerful, steady growth. The growth trajectory. Revenue and profit. The company's top-line growth has been remarkably consistent, with one major exception. As the data shows, there was a significant shock to the system in 2015. Note, the company changed its financial year from DEC ending to MAR ending. FY24 was a 15-month period, making direct year-Y comparison difficult for recent periods. TTM stands for trailing 12 months. The numbers from 2015 are stark. Revenue fell over 17% from Rs 9,855 crores in 2014 to Rs 8,175 crores. And net profit was more than halved, plummeting from Rs 1,185 crores to just Rs 563 crores. This was the direct financial fallout of the Maggi noodles crisis. However, what followed is a testament to the company's brand power. A sharp V-shaped recovery began in 2016, and since then, the company has been on a steady growth path. Over the last decade, Nestle India has achieved a revenue CAGR of approximately 10.2% and a profit CAGR of around 11.3%. The fact that profit has grown slightly faster than sales over this long period points to sustained operational efficiency and an improving cost structure. The engine of efficiency, profitability, and margins. This brings us to profitability. A key metric to watch here is the operating profit margin, or OPM. In simple terms, for every 100 rupees of product Nestle sells, the OPM tells us how much profit it makes before paying interest and taxes. Nestle India's OPM is a picture of stability and strength. Apart from a dip to 19% during the 2015 crisis, the company has consistently maintained its OPM in a healthy range of 21% to 24%. This level of consistency is exceptional and points directly to two core strengths: immense pricing power, which allows it to pass on rising raw material costs to consumers, and a highly efficient, well-managed supply chain. Furthermore, its return ratios are phenomenal. The return on equity, ROE, and return on capital employed, ROC, are consistently among the best in the industry, with ROE often exceeding 80% and ROCE topping 95%. This indicates that the management is exceptionally skilled at generating large profits from the capital invested in the business. A fortress balance sheet. Debt analysis. When it comes to debt, the story is simple and powerful. For all practical purposes, Nestle India is a debt-free company. While the balance sheet might show some minor borrowings, these are typically obligations like deferred tax liabilities and not conventional loans taken to fund operations or expansion. This debt-free status is not an accident. It is the direct outcome of the company's powerful business model. The market dominance of its brands provides a strong competitive moat. This moat allows the company to command premium prices, which in turn protects its high and stable operating margins. These high margins generate substantial and predictable cash flow from operations year after year. This internal cash generation is more than sufficient to fund all its capital expenditure needs, like building new factories, and to reward shareholders with generous dividends, with a payout ratio consistently above 80%. Because all financial needs are met internally, there is no need to take on external debt. This creates a virtuous cycle where brand strength leads to high margins, which leads to strong cash flow, which in turn ensures a debt-free balance sheet, providing immense financial stability for investors. The value investor's litmus test. Benjamin Graham valuation. With such strong fundamentals, one might assume the stock is a straightforward buy. But the father of value investing, Benjamin Graham, would urge us to first ask a crucial question. What is its intrinsic value, and what price is too high? To answer this, we can use his famous formula, the Graham number. The father of value investing. What is the Graham number? Benjamin Graham, the mentor of Warren Buffett, developed a formula to calculate the maximum price a defensive or cautious investor should be willing to pay for a stock. The idea is simple. If the current market price is below the Graham number, the stock is considered undervalued and offers a margin of safety. The formula is displayed on the screen. Intrinsic value, 22.5x earnings. Per share, EPS x book value per share, BVPS. The number 22.5 is derived from Graham's two fundamental rules for defensive investors. The price to earnings, PE ratio, should not exceed 15, and the price to book, PB ratio, should not exceed 1.5. Multiplying these two gives us 22.5, running the numbers for Nestle India. The verdict and why it's not so simple. The calculated Graham number is roughly Rs 90. Comparing this to the current market price of around Rs 1,162 reveals a massive gap. According to a strict interpretation of this value investing model, Nestle India appears to be significantly overvalued. However, this is where pure formulaic investing ends and deeper analysis begins. The Graham number is an excellent tool for finding traditionally undervalued stocks, average companies trading at cheap prices. But it has significant limitations when applied to what are known as quality compounders, like Nestle. The formula is explicitly designed to penalize companies with high PE and PB ratios. Nestle India's PE ratio is over 70 and its PB ratio is over 50, failing Graham's initial screening criteria by a wide margin. The reason for this is that the formula heavily weights tangible assets, book value, and current earnings while largely ignoring the immense value of intangible assets. For Nestle, its most valuable assets, the brand equity of Maggi, the trust in Cerelac, the global recognition of Nescafé, are not fully captured on its balance sheet. The market is willing to pay a substantial premium for this brand dominance, its vast distribution network, and its future growth potential. Therefore, the Graham number tells us something very important, but perhaps not what it seems at first glance. It confirms that Nestle India is not a Graham-style value stock. It does not, however, prove that it is a bad investment. It simply highlights a fundamental difference in valuation philosophy. The market values Nestle for its future potential and intangible strengths, whereas the Graham formula values it based on its present tangible reality. The two sides of the coin, pros versus cons, the bull versus bear debate. This brings us to a balanced look at the arguments for and against investing in Nestle India at its current levels. The bull case. Why investors pay a premium 1. The unbreachable moat. The primary argument for Nestle is its sheer market dominance, with Maggi holding over 60% of the instant noodle market, Cerelac commanding a near monopoly at 97% of the infant cereal market, and its confectionery brands controlling 73% of their segment. The company operates from a position of immense strength. This moat makes it incredibly difficult for competitors to challenge its leadership. 2. Financial fortress and shareholder friendliness. As we've seen, the company is a financial powerhouse. Its debt-free status, consistently high ROE of over 80%, and a generous dividend payout ratio exceeding 82% demonstrate both financial prudence and a strong commitment to returning profits to shareholders. 3. The urban growth engine. Future growth is expected to come from India's semi-urban and rural areas, a strategy Nestle calls urban. The company has aggressively expanded its distribution network, growing its reach from just 1,000 villages in 2017 to a target of 120,000. These markets are showing faster growth than saturated metros, providing a long runway for expansion. 4. The innovation pipeline. Nestle is not resting on its laurels. The company has launched over 140 new products in the last 8 years, with a clear focus on premiumization and entering new categories like plant-based proteins and health science. These new products not only drive growth, but typically come with higher profit margins. The bear case. The risks lurking beneath the surface. 1. Valuation. 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 The single biggest risk is the stock's sky-high valuation. A PE ratio of over 70 and a price-to-book ratio over 50 means the stock is priced for perfection. Any slowdown in growth, margin pressure, or negative news could trigger a significant price correction, as there is no margin of safety built into the current price. 2. The commodity squeeze. Nestle's margins are directly exposed to the volatility of global commodity markets. Key inputs like coffee, cocoa, wheat, and milk can experience sharp price increases. Recent spikes in coffee and cocoa prices have put what the company chairman called enormous pressure on margins, forcing price hikes that risk dampening consumer demand and volume growth. 3. Reputational minefield. The company's global scale and its presence in sensitive categories like infant nutrition make it a constant target for scrutiny. As history has shown, a single controversy can have severe financial and brand repercussions. This is a persistent risk that investors must be willing to accept. Essential due diligence. Controversies and global standing case study. The 2015 Maggi crisis. No analysis of Nestle India is complete without revisiting the 2015 Maggi crisis. It began when food regulators in Uttar Pradesh alleged that samples of Maggi noodles contained lead levels beyond permissible limits and undeclared monosodium glutamate, MSG. The news triggered a media firestorm and a crisis of consumer confidence. India's National Food Safety Regulator, FSSAI, soon imposed a nationwide ban, forcing Nestle to recall and destroy products worth over Rs 320 crore. The company's initial response was seen as defensive, but it quickly shifted to a full withdrawal of the product from the market. After months of legal battles, the Bombay High Court overturned the ban and newly tested samples were found to be safe. The key lesson from this episode is twofold. First, it demonstrates the vulnerability of even the most trusted brands to regulatory and media-driven crises. Second, and more importantly, the powerful comeback of Maggi to reclaim its market leadership after being relaunched showcased the incredible resilience and deep-rooted strength of the brand in the minds of Indian consumers. Echoes of the past. The baby food controversy. This risk of controversy remains relevant. In 2024, a report from the Swiss NGO Public Eye alleged that Nestle adds sugar to its Cerelac baby cereal and Nido milk products sold in India and other developing countries, while the same products are sold sugar-free in European markets. This has once again raised questions about the company's practices and has led to scrutiny from Indian regulators. While the outcome is uncertain, it serves as a reminder of the persistent reputational and regulatory risks associated with the company's high-margin nutrition business, a jewel in the global crown. Despite these challenges, Nestle India's strategic importance to its Swiss parent has never been greater. India is now the largest market for Maggi globally and the second largest for KitKat. It is consistently one of the fastest growing markets for the entire Nestle SA group. While Nestle India's revenue of around $2.4 billion is a small fraction of the parent company's massive $100+ billion global sales, its high growth rate in a market with enormous potential makes it a critical engine for the parent's future. The parent company is betting big on India, with plans to invest approximately $7,500 crore between 2020 and 2025 to expand its capabilities. Conclusion and disclaimer. So, what is the final picture of Nestle India? On one hand, there is a financial fortress, a company with an almost unassailable brand moat, dominant market share, zero debt, and phenomenal profitability. It's a machine built for consistent, steady growth, now aggressively tapping into India's vast rural potential. On the other hand, there is a stock that is perpetually expensive. An investor is paying a significant premium for that quality and stability. This investment carries the constant risks of volatile commodity prices squeezing its margins and the ever-present threat of a reputational crisis that could, at any moment, challenge consumer trust. Ultimately, the question for an investor is not just, is Nestle a great company? The numbers suggest it is. The real questions are, what price am I willing to pay for that quality? And am I comfortable with the inherent risks? This analysis was designed to give you a framework to answer those questions for yourself. Please remember, this video is for educational and informational purposes only. This is not a financial advisor, and this is not a recommendation to buy or sell any security. You should always conduct your own research and consult with a qualified professional before making any investment decisions. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor. Thank you for watching.